Good morning. In the last counseling session, we had started the discussion on overall performance measures. The return on investment we had discussed. Return on investment is net profit divided by investments. Benefits of ROI. ROI approach ensures that profits are viewed as a function of assets employed. Return on investment incentivizes the manager to maximize returns by controlling cost and eliminating non-value added activities. It encourages optimum investment into assets and increase revenues without additional investment. The ultimate test of profitability, as is often stated, is not the absolute amount of profit, but it is the relationship of profit to capital invested. Limitations of and difficulties with ROI. Though conceptually, ROI is an ideal index which relates accomplishments to resources used and tends to tie together the many phases of financial planning, sales objectives, and cost control and profit goal. Practically, however, it has been regarded as an imperfect or incomplete measure of performance. That is why it is often asserted that this technique should be used along with other performance yardsticks. The limitations of return on investment have been classified into two categories, technical and implementation. The first arises from those conditions which cause incongruities between investment center objectives and company objectives, and which result in motivating investment center managers to take uneconomic actions. The second type include those conditions that result from the inability under many circumstances to evaluate accurately the profit performance of investment center managers. Now we are discussing the second, residual income as a performance measure. To overcome some of the difficulties and limitations of return on investment approach as a yardstick for measuring the performance of investment centers. Another approach called residual income, first popularized by General Electric Company of USA, has been devised. Residual income is the difference between operating income and the required return on assets. In the formula, say residual income equal to operating income minus minimum rate of return multiplied by operating assets. Economic value added. Economic value added is after tax operating profit minus the total annual cost of capital. Economic value added equal to after tax operating income, that is profit, minus weighted average cost of capital multiplied by total capital employed. Since the income statement of the division includes a charge for the opportunity or cost of capital based on rates adjusted for the riskiness of the assets implied, it has been said that residual income reflects the true profit of the division. The divisions may differ not only in profit potential but also with respect to the nature of assets implied. Therefore, the budgeted levels of residual from one investment center to another. The RI measurement solves the conceptual problem associated with ROI measure. Under residual income, different cut-off rates can be charged for the same division, while similar rates can be charged for similar types of assets in different divisions. Under residual income, each division is assigned a budgeted residual income. The division manager may then concentrate on decisions that maximize residual income and is very likely to pursue goal congruent behavior. Return on investment and residual income, a comparative analysis. The significant characteristics of both return of investment and residual income is that they direct the attention of the investment center manager toward minimizing the investment in assets relative to net income. Sorry. If the manager can maintain the net income while reducing the assets investment, return on investment will be increased because the denominator of the fraction is made smaller. The residual income, however, directs the manager's attention more explicitly to the amount of income earned relative to investment. Let us explain this a bit. Residual income is net income minus investment multiplied by required minimum rate of return. The required rate of return, as we have stated earlier, is the capital charge, a charge for the use of capital invested in the division by the company. If the manager has a zero residual income, it means the division has exactly achieved the target return on investment. A positive residual income means that the target has been exceeded, and a negative residual income means that the target has not been achieved. The amount of the capital charge and thus residual income moves in the same direction as the amount of investment in the division. All the difficulties in relation to what should be included in the investment and at what amounts exist with residual income as with return on investment. Investment normally is defined as total assets at net book value, as is the usual case with return on investment computations. You might ask, what then is the advantage of using residual income? The primary reason is that it solves one additional problem which exists in the use of return on investment. Under return on investment, high return divisions may be tempted to refuse investment projects which, though desirable from corporate point of view, would reduce the division return on investment. This temptation does not exist if financial performance is measured on a residual income basis. Measuring investment base. The choice of assets base for assessing the performance of the investment center could be tangible and or intangible assets, controllable or uncontrollable, and or partially controllable assets, total assets and or total assets minus liabilities, etc. Each of these will have the effect of changing the return on investment. Similarly, the assets value could be gross block or net block, book value or market value or replacement value, etc. When the gross block of assets is used to calculate return on investment, then the choice of method of depreciation does not affect the return on investment. When the net value of assets is used in the base, to calculate return on investment, it might result in using a higher rate of depreciation or quick write-off of assets values, resulting in high return on investment. If a division operates with old equipment and return of assets that need to be replaced shortly, then the replacement of assets can be used to calculate return on investments. Allocation of central office assets. Many other assets in some companies and some of the assets in all companies may be directly identified or traced to particular divisions. It may not be quite uncommon to find some assets in the central office as directly relevant to particular divisions. Company cash requirements, for example, bear some relationship to the size and structure of divisional operations, even when cash is centrally administered. Traceability of assets is considerably facilitated where the company is engaged in diverse activities. From the economic standpoint, it has been stressed that the relevant investment base is the amount that is uniquely devoted to support a division's operations. And from the traceability point of view, the criteria that satisfies the definition is the criteria of avoidability. That is, what portion of the central office assets would be unnecessary if this division was not present. Efforts should be made to reduce non-traceable assets to the minimum. As traceable investment is regarded as close to controllable investment, it is a better measure for control purposes. The various bases used by companies to allocate central office assets are sales revenue, number of employees, services availed, conversion cost, or some ad hoc percentage. In order that allocations are not arbitrary, statistical analysis should be attempted to review usable relationship. Economic appraisal of investment center. For appraising the investment center as an economic entity, economic report is needed, which is diagnostic in nature and is meant to help evaluate current strategies so as to arrive at a decision whether to further build, expand, divest the division, or change its direction. The economic report will reveal whether the strategies and policies being pursued in regard to products, marketing, research and development, acquisition of plant and equipment, etc. are satisfactory, or they need to be changed for future satisfactory profits. Economic reports focus on predicting future profitability rather than analyzing what profitability has been in the past. Much of the information used in financial performance reports, like book value of assets or depreciation based on historical cost of assets, is not relevant for assessment of future for which replacement costs are considered more useful. Conceptually, the value of business unit is the present value of its future earning stream. This is calculated by estimating cash flows for each future year and discounting each of these annual flows at a required earnings, or what is known as a discount rate. The analysis may cover the next 5 to 10 years. Assets on hand at the end of the period covered are assumed to have a certain value, the terminal value, which is discounted and added to the value of the annual cash flows. Appraisal of managerial performance. In view of the pitfalls and inadequacies of the popular measurement techniques, that is, return on investment, residual income, or some other. Some authors have suggested the alternative of management audit for measuring and evaluating managerial and economic performance in decentralized structures. Management audit is a comprehensive, thorough, and constructive examination of the various aspects of the functioning of an organization or any of its parts with a view to evaluate its overall performance. It is a critical analysis of all conceivable areas of an organization and is usually undertaken by a team of internal and external experts or consultants. It highlights major areas that need attention and suggests measures to improve organizational effectiveness both in the short run and the long run. In management literature, it has been emphasized that key variables or key success factors, KSFs, should be established for each responsibility center, which would be instrumental for achieving the goals and objectives of the responsibility center. KSFs are those variables in the external environment to which the goals, objectives, and strategy of the managers are most sensitive. That is, performance is highly dependent upon them. The KSFs are crucial to the performance of organizational segments. They differ from industry to industry and therefore appropriate indicators of performance also differ for application. The key success factors in turn become the basis for establishing appropriate performance measures, designating responsibility centers, reward structures, and resource allocation procedures. In the course of a multifaceted study on profit center, including investment centers, it was gathered that managerial performance is evaluated on the basis of multiple indicators of performance rather than a single index of profit or ROI. Though the return on investment index has several benefits, as we have already examined, its imperfections and inadequacies are not unknown to the business world. It is perhaps in recognition of this fact that companies attempt to evaluate the performance through various other indicators, which are primarily of qualitative nature, along with return on investment or some other similar overall measure. Now, the next part of counseling, transfer pricing. An expressed characteristics of the market economy today is the establishing and functioning of complex and large enterprises with diverse production lines, hierarchy of rights and responsibility of employees, market dispersion, and decentralized organizational structure and management. Establishing organizational units include fragmentation of resources of enterprises and transferring competences and responsibilities for their allocation on cost, profit and investment centers. Although profit and investment centers are relatively independent units with their own goals, the recognized external market of goods and production factors, and their own profit responsibility, they are not totally independent from the other profit-oriented organizational parts of the enterprise. Namely, many business transactions could be performed between the units. Those so-called internal exchanges of products or services are the basis of the internal transfer Output of one profit center may be sold to the other profit units inside of the enterprise. This is the way to develop an internal market inside the decentralized enterprise. Its product, services become intermediate and valuable expression of the internal transfer seems to be internal transfer of prices. Transfer pricing has become one of the important elements of the efficient management of decentralized enterprise. What is transfer pricing? Multinational enterprises, MNEs, carry on business in more than one country, either directly or through branches or indirectly through subsidiaries. Whatever the form, the activities of an MNE, individuals operating units are really completely self-sustaining or independent with the result that transactions take place between these units. The price at which goods, services, or capital are exchanged between the related parties is known as transfer price. The transfer price is determined by the transfer pricing policies used within the related group. Methods and criteria of transfer pricing. Many enterprises today have a decentralized structure with some variation of vertical integration in which the result of one unit or center becomes the input of another unit. Transfer price is the financial basis used to quantify the transfer of products and services from one unit to another. Transfer pricing has become a very influential factor of efficient management and one of the most important elements in performance measurement of decentralized enterprise and its part. It should be obvious that a conflict is likely to arise in an enterprise between its center managers because the buyer center wants the transfer price to be as low as possible, while the seller center wants the transfer price to be as high as possible. When an exchange of products or services takes place between a center and an external party, the forces of demand and supply on market determine the price in external transaction. An exchange of products or services between a center and an internal party, however, poses a potentially more serious and complex problem than the external exchange. What transfer price should be set so that buying and selling centers acting in their own best interest will at the same time act in the best interest of the enterprise as a whole. This is a serious question because suboptimal decision making will result if either the buying center manager goes to an external supplier to satisfy his needs when he should have gone to the selling center manager, or the buying center manager goes to the selling center manager to satisfy his needs when he should have gone to an external supplier. The transfer pricing method used must be the one most beneficial to the enterprise. The following four interrelated criteria should be used to evaluate adequacy of the transfer pricing methods that are currently being used by profit or investment centers. Number one, goal congruence. The transfer pricing that are set should enable a harmonization of goals of enterprise as a whole and its parties or centers as well to avoid suboptimal decision making. Number two, motivation. Transfer price should not interfere with the process wherein the buying center manager rationally strives to minimize his cost, and the selling center manager rationally strives to maximize his revenues. Number three, autonomy. Each center manager should be free to satisfy his own needs, either internally or externally, at the best possible price. This also means a higher autonomy of profit or investment centers in the enterprise. Number four, performance evaluation. Transfer prices should enable objective evaluation of profit center results, giving the information for optimal decision making and real appraisal of managerial performance and economic value of particular parties of the enterprise. In accordance with the criteria, the transfer pricing method should be chosen in the way to be the most beneficial for the enterprise as a whole as for its organizational parties. Categories of intercompany transfer. There are various forms of intra-company transaction. These transactions can be in the form of number one, transfer of tangible property and intangible property. Number two, the provision of services and finance. And number three, rentals and leasing arrangements. To determine whether an intra-company transfer has occurred or not, the substance and situation of the transaction will determine whether or not a transaction has taken place, rather than whether an invoice is rendered. Universally, the basis for determining consideration for intra-company transaction is the arm's length principle. Sales of tangible property. Tangible properties are the physical assets of a business. Tangible assets can be further classified as current tangible assets and fixed tangible assets. It is the current tangible assets in the form of raw material, work in progress, sub-assemblies, and finished goods that constitute a major portion of the transfers in the form of sales that, that take place between related parties. Sorry. Sales of fixed tangible property also include all the machinery and equipment employed by businesses. Transfer pricing rules generally stipulate that arm's length prices be used for determining sales consideration for sale of tangible assets between affiliates or related parties. The most often used technique to determine arm's length prices is to compare the prices of comparable products and services. Comparable products are very similar, if not identical products, which are sold between unrelated parties under substantially similar economic circumstances. That is, when the market conditions affecting the transaction are similar and when the functions performed, risks borne, and intangible assets developed by the respective unrelated trading parties coincide with those of the related parties. Types of intangibles. The term intangible property includes rights to use industrial assets such as patents, trademark, trade names, designs, or models. It also includes literary and artistic property rights and intellectual property such as know-how and trade secrets. These intangibles are assets that may have considerable value even though they may have no book value in the company's balance sheets. There also may be considerable risk associated with them. For example, contract or product liability and environmental damages. Barriers to entry are also considered as intangible assets, as they create a situation where the profits of a company over a long period of time exceed the levels that would generally accrue to a normal for operating in similar economic conditions. There are four broad ways through which intangibles can be transferred between related entities, which are as follows. Number one, outright sale for consideration. Number two, outright transfer for no remuneration, that is by way of gift. Number three, license in exchange for a royalty, lump sum, or periodic payment based on a percentage of sale, sum per unit, etc. Or number four, royalty free license. The arm's length principle is difficult to apply in case of transfer of intangibles between related parties for tax purposes due to the following reasons. When both tangible and intangible features are bundled together to form a single product, it would be difficult to ascertain the precise nature of the transaction as the transaction involves a number of subcomponents representing both tangible and intangible features. Number two, the transaction may be for a product or service having a special character, thereby complicating the search for comparables, as very few or none of the comparable transactions may occur or exist. Number three, related parties for entirely commercial reasons within the ambit of prevailing commercial and tax laws may structure their transactions in ways that would generally not be structured and transacted by independent firms or unrelated firms. In this kind of situation, sound functional analysis can assist in application of the arm's length principle to intangible property. Functional analysis can help identify number one, the circumstances leading to the development and creation of intangible value. The entity that had financed the development and creation of intangible, and as a result to this, which entity the rewards will accrue to in case those intangibles are used by some other entity. Number two, who is the real owner of intangible? Number three, what is the true nature of transaction and features of property being transferred in the transaction? The terms and conditions under which a related party is using an intangible, for example, whether the user is a licensee of the intangible or merely a contract distributor, sales of both intangible and tangible property are treated in the same way. The transactions regarding these shall be based on arm's length standard and should reflect the fair market value of the property at the time of sale. The arm's length principle. The basic premise of the arm's length principle is that the compensation consideration for any intercompany transaction shall conform to the label that would have applied had the transaction taken place between unrelated parties. All other factors remaining the same. Factors that weighs in the determination of arm's length prices are type of transaction under review, the economic and commercial factors underlying the transaction, the form of the payment, namely either lump sum payment or a stream of royalty payments is spread over predetermined period. The arm's length principle requires that for tax purposes, the terms and conditions agreed to between non-arm's length parties, their related parties, for commercial or financial transactions between themselves will be similar or identical to those that arm's length parties in independent parties would have followed in their commercial and financial transactions while dealing with other. Or, as an example, if one department of a company is selling the goods to the other department of the company, the rate or the prices charged should be same as if the first department is selling the goods or services to the outside or to other parties. The prerequisite for application of the arm's length principle is that for the purpose of comparison of price or margin in transactions involving non-arm's length parties with those of the price margin in transactions involving arm's length parties, the transactions must be similar in nature. For the comparison to be valid and reliable commercially and economically, relevant characteristics of the transactions being compared must be at least sufficiently similar so as to permit reasonably accurate adjustments to be made for any differences in such characteristics. Comparison of transactions shall always between the transactions of related party with that of unrelated parties. Transactions between other non-arm's length parties should not be used for purposes of these comparisons because the terms and conditions may not be arm's length. Paragraphs 1.19 through 1.35 of the OECD guidelines indicate that must be taken into consideration to compare the transactions among unrelated parties. Some of these factors are the characteristics of the goods and services being transacted. Apart from the basic transactions, the additional functions performed by the parties to the transactions and the resources committed and risk assumed by each party. Number three, the commercial terms and conditions of the contract, the financial health of the parties, and last one, the commercial, financial, and business strategies pursued by the parties. The related parties entering into transaction and looking for comparable transactions must analyze the comparable transactions in light of the above mentioned points and exercise judgment in determining the level to which the transactions can be compared. The degree of comparison will also be influenced by availability of quality information regarding the factors present in the uncontrolled transaction between unrelated parties. Application of arm's length principle. There are a number of methods which, when applied correctly, can determine the arm's length price. These methods are also known as the recommended methods. These methods are divided into two groups. Traditional transactional method. Number one, the comparable uncontrolled price, CUP method. Number two, the resale price method. And number three, the cost plus method. Transaction method, the profit split method, and transactional net margin method, TNMM. Before choosing any method, the taxpayer should scan the environment for decisive data which can justify the application of any method. The reliability of any method depends on the availability of data and the accuracy which it can generate for making necessary adjustment to achieve comparability. Traditional transaction methods, comparable uncontrolled price CUP method. The comparable uncontrolled price method is based on the comparison of the consideration or price charged for transferring property or services in a controlled transactions, that is, transactions between related parties, to the price charged for property or services transferred in a comparable uncontrolled transaction, that is, transaction between unrelated parties. In comparable circumstances, a CUP method may be applied when an external and an internal comparable can be easily computed. Resale price method. In the resale price method, we start with the computation of comparable gross margin. The gross margins can be computed using external data or internal data. The internal comparable gross margin is generated by analyzing the resale price margin earned by parent or affiliate in comparable uncontrolled transaction, that is the transaction with unrelated parties. The external comparable is generated by analyzing the resale price margin earned by an unrelated entity in comparable uncontrolled transactions with another unrelated party. Under this method, the resale prices to arm's length parties of a product purchased from a non-arm's length enterprise is first determined. After that, an appropriate comparable gross profit margin, the resale price margin, is deducted from the resale price to arrive at arm's length price. Cost plus method. The starting point for the cost plus method is the computation of the cost incurred by a supplier of a product or services. The cost determination takes into consideration both the direct cost, materials, labor, etc., and indirect cost of production, factory overheads, etc. A comparable gross markup is added to these costs to determine an arm's length price for services and products provided to a non-arm's length enterprise. This comparable gross markup is determined in two ways: by reference to internal and external comparables. Internal comparables are determined by the cost plus markup and by a member of the group in comparable uncontrolled transactions. External comparables are determined by the cost plus markup earned by an arm's length enterprise in comparable uncontrolled transactions. Irrespective of the comparables used, the returns used to determine arm's length markup must be reflected of the transactions performing similar functions and preferably for selling similar goods to arm's length parties. When the transactions are not comparable in all respect and the difference manifests them in the form of tangible effect on price, taxpayers must make adjustment to eliminate the effect of those differences. Sorry. Profit split method. Under the profit split method, the first step is to determine the combined profit or loss arising from a controlled transaction. In the next step, the combined profit or loss that has arisen from the controlled transactions between associated parties is split among the parties associated with the transaction on an economically valid basis, based on the relative value of their contributions to the non-arm's length transactions, considering the functions performed, the assets used, and the risk assumed by each non-arm's length party in relation to what arm's length parties would have received. Here, two important points shall be kept in consideration. This method only splits, allocate the combined profit of a controllable transactions, not the total profits of the associated parties or group as a whole. The profit to be split is generally the operating profit before the deduction of interest and taxes. In some cases, it may be appropriate to split the gross profit. Transactional net margin method, TNMM. The application of TNMM requires comparison of the net profit margin of a taxpayer arising from a non-arm's length control transactions with the net profit margins realized by arm's length parties from uncontrolled transactions. And in addition, it also compares the net profit margin relative to an appropriate base, such as operating profit margin, earning before interest and tax, or sales, EBIT oblique sales, return on sales, return on total cost, also known as full cost markup, that is FCM, Berry ratio, return on assets, and return on capital implied. Berry ratio we will discuss just now. The main difference between the TNMM and cost plus and resale price methods is that in TNMM the net profit margin is compared instead of gross profit margins as used in cost plus and resale price method. As far as level of comparability is concerned, TNM cost plus and resale methods requires a similar level of comparability. Berry ratio. The Berry ratio focuses on profitability and operating expenses. By way of illustration, consider the case of a parent company that has performed all the research and development required to bring a product to market and has also manufactured the product. The finished goods are sold to a related entity which is responsible for selling the goods. In this situation, the simple entity is the selling entity and the complex entity is the manufacturer. The Berry ratio is sometimes used to determine pricing between these types of entities, and at its heart, this method is a cost plus method applying to selling entities. To compute the Berry ratio, it is necessary to determine the markup that a typical distribution earns on the selling, general, and administrative expenses, which it incurs. Specifically, the Berry ratio is calculated as the ratio of gross profit to operating cost and is used to mark up the SG&A, that is selling, general, and administrative costs of the selling affiliate in the intercompany transaction. All remaining income is attributed to the manufacturing entity. The advantage of the use of Berry ratio include the ease of administration and the lack of concern for the size of distributors used as comparables. Now the next part of counseling, management control process, budgeting and reporting. Budgeting and budgetary control. Budgeting and budgetary control are perhaps the oldest and most popular instruments used in planning as well as monitoring the operations of an enterprise over a short and medium term frame. Budgeting and budgetary control seek to direct the activities of the enterprise in a certain logical sequence and addresses some basic issues which are essential to the planning and control process. When the same issues are addressed over a long-term time frame, the exercise is called corporate planning or strategic plan. According to Chartered Institute of Management Accountants, UK, budget is a plan expressed in money. It is prepared and approved prior to the budget period and may show income, expenditure, and the capital to be implied. Plan is the end result of the planning process. A detailed and well-knit plan has two axes. Number one, fiscal, and number two, financial. Translation of planned activity for a definite period of time. Number one, into fiscal terms that result in programming. Number two, into financial terms that result in budgets. However, a good budgeting should subsume programming, that is fiscal dimension, also while the focus in budgets is on the financial aspects. Classification of budgets for different purposes. Budgets may be classified into different types and looked at from different view types. Functional or sectional sales budget, which shows the sales figures. Selling and distribution cost budget. Production budget. Production cost budget. Purchase budget. Plant utilization budget. Administration cost budget. Research and development cost budget. Personnel budget. Number B, consolidated cash budget to include capital items also. Summary budgets, master budget containing inter alia statement and balance sheets. Number C, expense behavior wise. Number one, fixed budget. Number two, flexible or multiple budgets. On the basis of periodicity, basic budget or long-term budget, current annual budget or annual business plan. Number three, shorter period budgets, annual budgets broken down into quarters or months. Sometimes it is also broken into weeks. Responsibility wise, cost center budgets, profit center budgets, revenue center budgets, emphasis or approach wise, production oriented budgets, under sellers market situations, market oriented budgets under buyers market situation. Building block, budgeting and reporting. Number one, principal budgets, primarily financial and partly quantitative. Number two, subsidiary or support budgets, primarily quantitative and partly financial. Management style or level of participation. This classification is, of course, not very relevant in actual practice. Authoritative and participative. Very often, a judicial band of many of the above classification is obtained to obtain the desired result. Building blocks of budget or budget setting process. Important considerations. There are certain important issues that need to be examined and sorted out before starting the detailed budget setting exercise. These are briefly discussed below. Number one, corporate objectives. Companies having systematic and organized long range planning process will always have before them such long term objectives is spelled out clearly and quantified. The companies which do not have a LRP system should also develop a broad outline about its objectives on a long term basis, at least for 2 or 3 years. The objectives should be especially in two respects: growth and profitability. Preferably, these should be broken up into present products and lines of activities on the one hand, and proposed new products and new lines of activities on the other. Corporate profit planning. Profit planning and budgeting are not two different things. They are rather independent and more precisely complementary to each other. Profit planning should precede the detailed budgeting exercise. Basically, profit planning provides a general blueprint of the expected profits and the broad elements through which these can be achieved during a particular budgeting period. By its very nature, it is a summary plan, not backed up by a detailed action plan. From a practical point of view, it is always possible to implement a detailed budgeting plan without requiring a detailed action plan. However, it is not always possible to implement a detailed budgeting plan without requiring a detailed action plan. Very often, a judicial band of many of the above classification is obtained to obtain the desired result. Building blocks of budget or budget setting process. not backed up by a detailed action from a practically. Profit planning provides a general blueprint of the expected profits and the broad elements through which these can be achieved during a particular budgeting period. By its very nature, it is always